Saturday breakdown. Fed shocked every investor. What is happening next in market? Something just changed at the Federal Reserve, and most investors have absolutely no idea what it means. On Wednesday, June 17th, 2026, Kevin Warsh walked up to that podium for the very first time as chairman of the most powerful central bank on earth. And what came out of that meeting was not what the market expected, not even close. Gold dropped, silver got hit, the dollar surged to its highest level since May 2025, and by Thursday morning, Wall Street was quietly repricing everything. So what actually happened? What did Warsh signal? And most importantly, what does this mean for your money right now? Stay with me, because by the end of this video, you will understand what 99% of retail investors are completely missing this weekend. Let me be very direct with you. This was not just another Fed meeting. This was a regime change. For years, the Federal Reserve communicated in one way. They gave you forward guidance. They told you where rates were going. They told you what to expect. Powell would stand at that podium and practically read the market a bedtime story. Warsh just ended that era, completely. And the market is still trying to figure out what it means. Here is what we know. The Fed held rates at 3.50 to 3.75%. That part was expected. But underneath that hold, the dot plot told a completely different story. 9 of the 18 FOMC officials are now projecting at least one rate hike before the end of 2026. 9. That's half the committee. 3 months ago, in March, the median dot still implied a cut. Let that sink in. The Fed just flipped from cutting to potentially hiking in a single quarter. And silver, which had just ripped to almost $70 an ounce on the Iran peace deal, gave it all back in a matter of hours. So is this a disaster for precious metals? Or is this actually the setup most people are not seeing? Let's break it all down. To understand why this moment matters so much, you need to understand who Kevin Warsh actually is. This is not a typical central banker. Warsh served on the Federal Reserve Board during the 2008 financial crisis. He was there when the system nearly collapsed. He watched Ben Bernanke run the money printer at full speed. And for years after that, he has been one of the most outspoken critics of how the Fed communicates, arguing that forward guidance has made markets dangerously dependent on central bank handholding. Trump picked him for exactly that reason. He wanted a hawk. He wanted someone who would rebuild credibility on inflation. And on Wednesday, Warsh delivered. Here is what he said at the press conference. Quote, "There is no reason to revisit the 2% objective until we've reached it." End quote. Simple sentence, devastating implication. Because right now, inflation is not at 2%. May CPI came in at 4.2%. The Fed's own median forecast for PCE inflation, their preferred measure, was just revised up to 3.6% by year end. That is nearly double their target. And yet, in March, these same officials were still penciling in rate cuts. What changed? Everything. Tariffs are pushing prices up. Energy markets remain volatile. And now you have a new Fed chairman who has made it crystal clear. Price stability is the only job that matters right now. The market consensus on Thursday put the Fed funds rate finishing 2026 at 3.98%. At the start of this year, the Fed's own dot plot showed rates at 3.40% by December. That is nearly a 60 basis point swing in expectations inside 6 months. That is not a small adjustment. That is a fundamental repricing of where money is going to cost. Now here is where most retail investors make their mistake. They see hawkish Fed, they see rate hike risk, they see gold and silver selling off, and they panic. They say the trade is over, they walk away. Smart money does something very different. Smart money reads what is underneath the surface. And what is underneath the surface right now is one of the most fascinating contradictions in modern monetary history. Think about this for a second. The Fed is signaling possible rate hikes. That is bearish for gold on paper. Higher rates mean a stronger dollar. Stronger dollar means gold gets pressured. That is the textbook response. But here's what the textbook does not account for. The United States is carrying nearly $40 trillion in national debt. 40 trillion. Every single percentage point increase in interest rates adds hundreds of billions of dollars per year in interest costs to that debt load. The math at some point becomes impossible. And every serious economist knows it. So what you actually have is a Fed that is trying to sound tough on inflation, while the fiscal reality of America makes sustained high rates increasingly difficult to maintain. This is what I mean when I say the structural case for gold and silver is completely separate from what Warsh says at any individual press conference. The World Gold Council just reported this same week that a record 45% of central banks globally plan to add gold to their reserves. 45%. That is not a coincidence. That is a signal. Central banks are not buying gold because they think the Fed will cut rates next month. They are buying gold because they understand what is coming at a much deeper level. And that is what most retail investors completely miss. But let us come back to this week, because the week of June 16, 2026 was genuinely chaotic in a way that tells you a lot about where we are. Monday and Tuesday, silver rips 2.8% on the Iran peace deal. The war premium in oil collapses. Markets cheer. Silver briefly touches $69.85 an ounce. Investors are excited. Wednesday afternoon, Warsh steps up to the podium. The dot plot drops. 9 officials projecting a hike. Dollar surges to its highest since May 2025. Silver posts its sharpest single-session drop in weeks. Thursday, silver recovers nearly 70% of the loss. Friday, the market is still trying to make sense of everything. This volatility is not random. This is exactly what happens at a pivot point in monetary history, when a new Fed chair takes over, when the policy framework is shifting, when the market does not yet have a clear map of where this new regime is going. And here is the thing about Warsh specifically. He did something Wednesday that no Fed chair has done in years. He skipped the dot plot submission himself. He refused to provide his own rate projection, and he eliminated forward guidance from the policy statement. The statement got longer, but paradoxically said less about the future. That is a deliberate communication strategy. Warsh is telling the market, do not try to front-run us. We will decide meeting by meeting, based on data. Now ask yourself, if you are an investor, what does that environment reward? It rewards assets that do not need central bank support to hold their value, assets that have intrinsic worth, assets that have performed across centuries of monetary regimes, gold and silver. I want to be honest with you for a moment. Because I know some of you watching this are sitting on positions in silver and gold right now, and this week hurt. It was confusing. You watch silver touch almost $70 and then get slapped back down within hours. That feels terrible, and I understand that. But let me give you some historical context that might change how you see this moment. When the Fed signaled rate hikes in June 2021, gold dropped. The market panicked. Headlines screamed that the gold bull market was over. Do you remember what happened next? Gold worked through the volatility, consolidated, and then the structural pressures that were building, inflation, debt, geopolitical instability, eventually overwhelmed the short-term rate noise. We are in a similar moment right now. Here is the real question you need to ask. Is Warsh's hawkish signal backed by an economy that can actually handle higher rates? Look at the data. The Bank of America economist Aditya Bave put it plainly. The June dot plot could show the Fed on hold for the rest of this year, with rate hikes more of a signal than a real commitment. Nikki Shields from MKS PAMP called the FOMC statement hawkish, full stop. And that is accurate. But there is a difference between being hawkish in communication and being able to execute on that hawkishness without triggering a recession or a debt crisis. 17 of 18 FOMC officials said the risks to inflation are tilted to the upside. But CPI at 4.2% is being driven heavily by tariffs and energy, factors that are not classic demand pull inflation. They are supply-side shocks. And Warsh himself at the press conference left room for this interpretation. He emphasized price stability repeatedly, but he was careful about characterizing the source of inflation. If these conditions continue, if oil prices stay soft, if the Iran peace deal holds, if tariff pressures ease, then real yields could compress. And compressed real yields are historically one of the most powerful tailwinds for silver and gold. The setup is messy right now, but messy does not mean broken. Let me walk you through the 3 things that are going to determine what happens next in precious metals, and I want you to think about each one carefully. Number 1, the dot plot spread. Right now, the 2026 rate projections span from 3.4% to 4.4%. That is a 1 full percentage point spread across the committee. That tells you this is not a consensus. This is a divided Fed. 9 officials want to hike, 8 want to hold, 1 still wants to cut. When the committee is this divided, the chair has enormous power to shape outcomes. And Warsh chose not to even submit his own dot, which tells you he is reserving optionality. He is not committing. He wants the data to guide the decision. That is actually less hawkish than the knee-jerk market reaction suggested. Number 2, the inflation story. PCE inflation at 3.6% is above target. But the Fed revised up its forecast because of tariffs and energy, not because of a wage spiral or excessive consumer demand. Those are very different inflations. Supply-side inflation is genuinely harder to fight with interest rates. You cannot raise rates to fix a tariff. You cannot make oil cheaper by making money more expensive. The Fed knows this. Warsh knows this. The question is whether they tighten anyway to protect their credibility, even if it hurts the economy, or whether they find a way to declare partial victory and hold. Historically, central banks that tighten aggressively into supply-side inflation tend to cause recessions. And recessions, ultimately, are bullish for gold. Number 3, the currency and debt dynamic. The dollar surged this week on the hawkish signal. A stronger dollar pressures commodities. That is real, and it matters in the short term. But the dollar's long-term trajectory is tied to something much more fundamental. 40 trillion in debt, a fiscal deficit that keeps expanding, a government that cannot realistically sustain high interest rates for years without a financial crisis. Market consensus now puts the Fed at roughly 4% by year-end. If that happens, the interest cost on 40 trillion in debt becomes staggering. The political pressure to reverse course becomes enormous, and history teaches us every major debt cycle ends the same way, with currency debasement, with inflation, with a flight to hard assets. This week was a short-term shock. The long-term math has not changed. So where does this leave you right now? Here is my honest read of the situation. Silver at these levels, after the Fed-driven pullback, is being repriced by paper market dynamics. Short-term dollar strength, short-term rate hike fear, short-term sentiment. But the physical fundamentals have not moved an inch. The industrial demand story for silver, solar panels, EV batteries, AI infrastructure, defense electronics, is accelerating. The annual supply deficit in silver is structural. Mining production cannot keep up with where demand is heading. And now you layer on top of that the monetary dynamic. A world where 45% of central banks are adding gold. A world where the US dollar's reserve currency status is quietly being questioned in Riyadh and Beijing and New Delhi. A world where the debt load makes eventual currency debasement not a theory, but a mathematical inevitability. None of that changed because Warsh skipped his dot plot submission. What did change is short-term sentiment. And short-term sentiment is not where wealth is built. The investors who look back on this period, 5 years from now, and say they bought silver in the mid-60s while everyone else was panicking about the hawkish Fed, those investors are going to have a very interesting story to tell. If the structural conditions continue, if debt keeps rising, if industrial demand keeps accelerating, if central bank gold buying keeps expanding, then the math begins pointing towards silver prices that most retail investors cannot even imagine right now. I am not giving you a price target, I am giving you a framework, and that framework says short-term noise versus long-term structure. Know the difference. There is one more dimension to this that I think almost nobody is talking about, and it is the most important thing I want to leave you with. Kevin Warsh is not Jerome Powell, and that matters in ways that go beyond interest rates. Warsh came into this job with a mandate to rebuild institutional credibility. He wants the Fed to be feared again. He wants inflation expectations anchored. He wants to be seen as tough. That is a political and institutional objective as much as an economic one. But here's what happens when credibility building collides with economic reality. If the economy starts to slow, if unemployment ticks up, if consumer spending cracks, if credit tightens too hard, Warsh is going to face enormous political pressure from the White House to reverse course. We already know Trump pushed hard on Powell for rate cuts. That dynamic does not disappear just because Warsh is the new chair. And if Warsh does pivot, if economic conditions force him to abandon the hawkish stance faster than the dot plot suggests, then the repricing in gold and silver could be violent to the upside. Because the market will have already priced in the hawkish scenario, any reversal would catch a lot of people short. This is what makes the current setup genuinely asymmetric for those who understand it. If Warsh stays hawkish and the economy handles it, precious metals face continued headwinds, but the structural floor holds. If Warsh is forced to pivot, and the history of central banking suggests that is more likely than not when a real economic slowdown arrives, then gold and silver could move in ways that make this week's volatility look completely irrelevant. Let me bring this home for you. This week was historic. Kevin Warsh's debut changed the communication architecture of the Federal Reserve. The dot plot shifted from cuts to hikes. The dollar surged, silver got hit, and the mainstream financial media spent the whole week telling retail investors to panic. But the investors who understand cycles, who understand debt, who understand money, who understand history, they saw something different. They saw a moment of maximum short-term fear. And they know that maximum short-term fear is usually where the most interesting long-term opportunities live. The question you need to sit with this weekend is not, what did the Fed do this week? The question is, what does the next 3 to 5 years look like for a world drowning in debt, with inflation above target, with central banks quietly stacking gold, with silver demand running ahead of supply, and a new Fed chair who just told everyone he will not give them a roadmap? In that world, what is your money doing? That is the question that actually matters. We will be back with more breakdowns as this situation develops, because one thing is certain, this is only the beginning of the Warsh era, and the next few meetings could change everything. Stay informed, stay ahead. Next video, I am going to break down the one number inside the June dot plot that everyone is ignoring, and it may be the single most important signal for where silver is heading before year end. Do not miss it.